Ever since Bitcoin was created, awareness and adoption have steadily risen over the last decade. As more speculators try to get involved with this high-returning yet risky new asset class, demand for Bitcoin ETFs has surged, reflecting the anticipation players in this field have been eager over the years. The first Bitcoin ETF application was submitted back in 2013 by the Winklevoss twins, but faced repeated rejections and delays from regulators. Years and years after many institutions refilled on Bitcoin spot ETF over and over again, yet they were unfortunately all got rejected without any discussion held from SEC. Nor a reason as to why they were all denied until recently the appearance of a Bitcoin spot ETF application submitted by the renowned fund manager, BlackRock, has managed to pressure the SEC and has finally paved the way for the approval of all 11 Bitcoin spot ETFs on different institutions at once on 10th of January in the USA, though there are some drama in the scene. But what is ETF? Why it is such a big deal for the Bitcoin hodlers? What's the deal behind it? An ETF, short for exchange-traded fund, is a financial product that tracks, mirrors an underlying asset or index, and are a unique type of open-end fund that has the hybrid benefits of both closed-end and open-end funds. With ETFs, investors get the flexibility to trade shares on the secondary market like stocks. But authorized participants, that means the big players, also get the ability to directly subscribe or redeem shares with the ETF issuer. Let's take a look at mutual funds. Trading mutual funds is like passing your money to the bank in the hope of getting a good return. You get to choose between low risk, medium risk, and high risk financial products to invest in, each with different returns and risk levels. Let's say you pick a high risk financial product, they trade a group of high risk stocks, and overall it makes you positive gains as speculated based on the market price. Things seem positive and you're looking forward to celebrating, but after a while, poof. Things go in the opposite direction and you start losing money. You can do nothing but pray, pray and pray, since that's your only option, pray. Your money is trapped by the investment manager, whom you have no control over in terms of closing your position. If you call them up, they'll say hold my beer. You chose the high-risk package. Everything is normal, everything is okay. The world keeps spinning and you'll be fine. Things get worse and you end up with a net loss of 50% in a day caused by a random black swan event. Your initial investment of $10,000 is now only $5,000. Because of the nature of redemption of mutual funds are not executed in real time, while there's a lag for the payment to proceed. The unit price is locked at the NAV, or known as net asset values, applicable on the day the redemption request is received. This ensures that investors get the NAV that reflects the market value on the day of their redemption request rather than on the day the payment is actually made. So that's why you could only pray for a stop if a crash is happening when you invested on a mutual fund. And this is where ETFs come in handy for average traders like us. Unlike mutual funds, trading ETFs allows you to control your own trades just like usual stock trading. You just need to register with a licensed investment manager, then you're able to start trading right away. ETFs also have a specialty. Not only can you take long positions, you can short the market as well. Secondly, as an average trader with around $10,000 in startup capital, we may have difficulty purchasing, say, one share of the Dow Jones, which is currently priced around $37,000. Given that most licensed investment managers do not offer high leverage trading, how could you trade that when the margin requirement is so big? But with ETFs, the investment manager is more likely to slice it into smaller pieces, like 1 in 100th of the Dow Jones's price, allowing even small-time traders to participate in the market. Okay, now you have an approximate idea of what an ETF is. So let's dig into what a Bitcoin spot ETF is. A Bitcoin spot ETF isn't something mysterious, it's just what's behind it that is. Let's first explain what a Bitcoin spot ETF is. A Bitcoin spot ETF is an exchange-traded fund that directly holds Bitcoin as its underlying asset. This means the spot ETF's performance is directly mirrored by the ETF issuer to the real-time value of Bitcoin. When investors like you and me purchase shares of a spot ETF, we are technically purchasing Bitcoin, even though we don't personally hold the cryptocurrency ourselves. What this means is that investors get direct exposure to the market without having to hold the asset. So how things actually works? Here's an ETF issuer issued a Bitcoin spot ETF called, let's say, BITT. If BITT is holding 1,000 Bitcoin and has issued 1 million shares, then theoretically each share would represent 0.001 Bitcoin. This means BIT's performance is directly linked to the real-time value of the Bitcoins it holds. Say when you bought 1 share of BITT, you're actually holding 0.001 Bitcoin. Though the numbers of ETF shares will be readjusted by the ETF issuer based on the demand to properly mirror the price of Bitcoin to balance the premium and secondary market price through the creation and redemption mechanism of ETF shares. If this is confusing, it literally means to mirror the price of Bitcoin. They frequently adjust the supply of ETF shares to fit the real-time demand in the market. Now, based on the SEC's policy, the creation and redemption of the ETF shares must be done through cash. Under this model, the cash create and cash redemption, authorized participants provide cash to the ETF fund to create new shares and receive cash in exchange when redeeming shares. The SEC prohibits directly exchanging Bitcoins for ETF shares between the issuer and APs. There must be a cash intermediary to comply with regulations. This is what's known as the cash redemption requirement from the SEC. Though according to Bloomberg analyst, the cash redemption may affect the accuracy on mirroring the price of Bitcoin. Aside from that, the ETF cash redemption also provide authorized participants to redeem the holding of GBTC ETF shares, like what has happened to GBTC recently. Actually, this is pretty much an unexpected event, because it's a gamble that GBTC could turn into ETF, allowing conversion to be happened since Fed has been the good guy all the time. This provides them the opportunity to redeem the ETF shares they have bought on the secondary market to cash as the premium is closing to 0%. Note that the lowest premium for GBTC was minus 50%, technically saying retail investor who's gonna purchase on the primary market pays $1, say for example. Then this share was trading at 50% discount on the secondary market. You bought it for $1, and it's now worth 50 cents on the secondary market. Who would hold it? Since then the dumping is more severe, causing the premium price to go even lower. Cause GBTC was an ETF at the time, redemption is not possible. So when GBTC was approved for ETF, and when cash redemption is possible a day after ETF is approved, which is 11th of January, the dumping of Bitcoin started, which many believed causes a price downfall for Bitcoin. Anyway, ETF isn't entirely a bad thing. Here's the pros. Easier and more convenient way to invest. Bitcoin spot ETFs can be traded through regular stock trading accounts and apps without needing to worry about the learning curve of cold storage wallets, private keys, ledgers, security, etc. Yeah, most traditional finance, or known as TradFi traders, dislike having to learn those things. Market participation. Traders can really participate in trading Bitcoin through the ETF, though indirectly. Better liquidity. Liquidity is more sufficient for trading the ETF on secondary markets. You don't have to worry about no one accepting your trades. Security. Not only do you have lesser worries about losing private keys or assets being hacked, trades made under the ETF are also protected by regulators like the SEC. So what about the cons of Bitcoin spot ETF, you asked? Unlike cryptocurrency exchangers, operation hours for traditional finance only available on US trading session. Like, what's the big deal here, you ask? You, anyone, everyone who is listening, do you realize how volatile when it comes to trade on Bitcoin? Imagine this thing went on the opposite of your trading direction by 30% during the closed operational hours, not to mention weekends and holidays. You would definitely freak out when you realized your position is minus 30% as the market open. Additionally, high fee. You say what? Yes, high fees, though it's trading Bitcoin through ETF is convenient when it comes for taxation, because your ETF issuers literally did all the tax calculation whenever a trade is done, and 0.25% fees may sound little. But comparing to trading on a cryptocurrency exchanger, fees are literally 0.01% or lesser than that. So what it meant for Bitcoin? If you have a sharp eye, you may have noticed that ETF issuers actually hold real Bitcoin when retail investors place buy orders. So why is a Bitcoin spot ETF such a big deal? Remember, Bitcoin and cryptocurrencies have always been popular trends among youth, and this trend has yet to die out even though most governments decided a ban on it. Like what most usually says, legends never die, and neither does Bitcoin. Anyway, as Bitcoin gains more mainstream exposure and adoption, this provides incremental stability and liquidity, suggesting a solid price floor. To spark our imagination, take crude oil for example. Back in the around 60s, crude oil was priced below $2 per barrel until increased exposure and adoption of oil drove up related industries and its prices, though Bitcoin is not a commodity. It is sparking related industries like digital currencies, blockchain technology, altcoins, mining rigs, etc. If I recall correctly, the collective wealth of baby boomers in the 60s to 70s had better distribution than later generations. If these players enter the Bitcoin market, it could mean really big for Bitcoin. Nonetheless, the approval of a Bitcoin spot ETF in the US also means Bitcoin is legally recognized as an investment product, no longer just a tool for money laundering or other fancy labels. That's why the Bitcoin spot ETF is big news, because it impacts the future positively for the cryptocurrency. Finally, SEC has a word here.
And obviously, the Commission and the staff of the Commission is still hard at work on a number of issues, one of them dealing with a number of filings of spot Bitcoin ETFs. You know, Mr. Chair, I have to ask you this question. There has been a lot.
I suspected we did something very significant about the $26 trillion Treasury market, which is really the base of our entire capital markets. It's how we fund our government. It's how our Federal Reserve does monetary policy. It's how we maintain the dollar dominance around the globe. And you want to ask me about crypto?
In my defense.